If you want monthly dividends with a very nice yield with a company that is not only undervalued but also pays special dividends every single year, then look no further than Main Street Capital. Now, they are a BDC, and we will run through in today's episodes looking at their dividend safety, their financial metrics, which are very important, as well as the stock valuation model, getting to our intrinsic value and finding our acceptable buy price given our margin of safety. We'll also take a look at what the institutions have been doing lately, buying or selling. We'll analyse how they're performing versus their peers over the last 5 years. We'll have a quick look at the health of this company, as well as how their top line revenues and bottom line net income are progressing over the years. Now, it is up around 16% year to date towards the upper end of the 52-week range, but do bear in mind 52-week high is not a signal for undervaluation, and they pay monthly dividends of just under 7% currently. Now, if you've been holding this company over the last 10 years, well, you would be up around 45%, bearing in mind it doesn't include those dividends reinvested every month, and we can see its all-time high is roughly around $45, which it has hit a few times. Now, in terms of their revenues year on year, we do like to see 3 to 7% growth, 233 million in 2018, 377 in 2022, so nice growth over the period, and on top of that, the trailing 12 months looks to show us signs of incredible growth into December 23, and don't forget, subscribe and hit that bell button so you are notified when we receive the latest Main Street Capital information. Year on year, well, what we can see, it has increased to 2019, before decreasing in that COVID year and then rebounding very nicely, and we do expect a nice increase into 23. Bottom line net income, what story do we see here? 168 million in 2018, 242 in fact in 22, so very nice increase, and again, very nice increase expected in 23. Very similar to the top line, although we see a longer period of decrease from 2018 to 2020 before rebounding and then dropping and then picking up. So top line revenue is increasing over time, so is the bottom line, but at a more inconsistent rate. Quick health check. Total cash versus total debt, 54 million of cash and short-term investments in 2018, 77 million from their latest quarterly report. And when we compare that to their total debt, we see they have around 100, or in fact 1 billion in 2018 and just shy of 2 billion in 22-23. So it has increased over the last 5 years, and we'll analyse some of their metrics to gauge the safety and the health of their balance sheet. Now, in terms of how they've performed versus some of their competitors, Gladstone Investment, Ares Capital, just to name a few of the popular ones, well, year to date, up a very strong 24%, and in fact, the industry as a whole, as we can see, has performed very well, with only PSEC down on the year. And when we look at the 5 years, remember this includes those dividends reinvested every single month. They are in fact one of the worst performing over the last 5 years, but still up a fairly healthy 62% year on the 5 years. So something just to bear in mind, but always remember, past performance is never an indicator for the future. Around 49 million worth of shares sold by the institutions over the last 12 months, but bear in mind 157 million have been bought during the same period, so a lot more buying by the institutions, and just going by the last 4 quarters, a lot more buying every single quarter than selling, as we can see the red depicting outflows, green inflows. But as always, don't just copy what the institutions do, and always do your own due diligence. Before we jump into the metrics, we can have a look at their earnings. And in conclusion, they had a double miss in Q3 of 23 in their earnings. But every quarter before then, Q3, in fact Q2 double beat, Q1 double beat, and Q4 of 22 a double beat. So unfortunately, they did miss a double miss, in fact, in their latest earnings, but very marginal, as we can see, 1 cent on the EPS and just a few 100 million on the top line. Now, as always, I do like to look at the comparative year-on-year data. I do find it a lot more helpful than just looking at analysts. Top line up 25%, bottom line up 87%, both net profit margin and operating margin up. So very, very strong. Lots of positives to take from this company and their latest earnings and comparative data. Dividend safety score, now it is 62, so it is safe. Market cap 3.5 billion. It is a mid-cap company. Now, in terms of recessionary metrics, for those that see a recession inbound, they maintained the dividend during the 07-09 recession. Negative 8% sales, which surprisingly is above the average growth of companies, which was negative to a larger degree. And they also outperformed the S&P quite considerably at negative 25% versus the S&P's negative 55%. Now, dividend growth, one thing that is slightly mediocre that we can see, 2% increase this year. Not the greatest, just given the fact that I always advocate for 4% or more on the channel. But do bear in mind this company does pay a special dividend every year. Last 5 years, 3% year on year. Last 10 years, at least, is keeping up with inflation. And if we look, we can see they have been paying increasing dividends over the last 12 years. Now, as I mentioned, they do special payouts, as we can see here, which is irregular to the essential monthly dividends that they do pay out. And when we take a look at dividend yield theory, well, it states a company is undervalued when the current yield sits above the 5-year average. 6.83 versus 6.5. You could argue reasonable valuation. You could also argue undervaluation. But when we look at the forward PE, we have a signal here of undervaluation, with the forward PE sitting at 10.7 versus the 5-year average of 15. Sector PE essentially in line with financials at 10.9. Now, when we take a look at the free cash flow, which is what we always draw your attention to, for BDCs, they are more volatile, so we focus on earnings. Below 95% is the preference for BDC companies, business development companies, and we can see this is a red flag indicator, as I always mention. Essentially means for 2020 they paid out more in dividends than in earnings, so something to be aware of. But 2022 it has come down 79%, 2023 expected 67%, so that is something that is positive to see, but something I would advise you to keep your eye on. Earnings per share, 206 in 2013. 1.5 times to that, 3.29 in 2022. It is expected to go up higher in 2023. It isn't one that consistently grows year on year, but it does overall move in the right direction. Always good to know what kind of company you're investing in, whether it is one that does increase rapidly year on year or one that is very inconsistent. Now, in terms of their sales growth, we can see double digits for the majority of the years. We see that COVID drop in 2020, but the last 2 years, double digits at 30%, very strong. 2023 expected 41%, so that is very, very positive. Shares outstanding, now it is typical for BDCs, very similar to REITs, to issue shares to grow their company, as we can see. Very, very continual and consistent year on year. So just bear that in mind. It has essentially more than doubled from 2013 to 2022. And for those that like to see the numbers on the sales, well, it has gone up by more than 3 times over the last 10 years. 116 million in 2013 to 377 million. ROIC, well, around 8% or more is what you could gauge for BDCs. Other companies, I like to see 10% or more. REIT, 3 to 5%. It is fairly consistent, 7 to 8%. I can accept that personally. And 2023 expected to be 10% is a positive sign. Now, typically, we like to look at the operating margin, but it isn't useful for BDCs, as interest is essentially a core component of their revenue and expenses, and this also translates to the net debt to EBITDA figures. So, Main Street Capital, lots to love, a few things to be aware of moving forwards. Let's jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button. Let me know if you enjoy more of similar content, and it lets me keep up with this content. As always, do click on that pinned comment below so you can grab a copy of the intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio. Now let's jump straight in. Graham's valuation. Now, similar to REITs, we don't tend to use this formula. It's not relevant for REITs or BDCs. So let's jump into the first one we're using today, the multiples valuation model. Companies in a similar sector and size, their PE, average PE multiplied by the earnings per share of Main Street, and we get a stock price of $55. When we take a look, that is some nice upside to the current trading price, and in fact well above the 52-week high, showing some nice signs of undervaluation based on this model. Do bear in mind though, we don't look at any of these models in isolation, and we will draw our conclusions towards the end. We then have the DDM, dividend discount model, with the yearly dividends. Now, average growth rate of 5.5%. I have gone a lot more conservative at 2.5, although if you grab a copy of the model below, you can plug your own numbers in to get to your own DDM and other prices. So this comes to $53, again, above the 52-week high, some nice signs of undervaluation to the current market value. Now, the DCF model isn't one we can use given the free cash flow is volatile, so we will jump straight to the output, which is essentially the intrinsic value, which for today's episode is the average of these two models, coming to $53.81. Now, the current price at $42, we start off with a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. It is a buy up to $48. At 15%, still a buy up to $46. At 20%, a buy up to $43. And if we go to 25, we can see it is not a buy until $40. So at a 20% margin of safety, it's a buy at around $43. So right now we are saying that with Main Street Capital, you are locking in a 20% margin of safety. What do Wall Street say? Well, they do believe there to be some upside over the next 12 months, but not that much, only around 5%. So in conclusion, we believe that there's a 20% margin of safety on Main Street Capital with around 5% upside per Wall Street analyst. Remember, this company not only pays monthly nearly a yield of 7%, but they also pay out special dividends, which I'm sure those who do already hold it can explain more information on that in the comments. As always, let me know your thoughts. Smash the like button if you've enjoyed today's content, if you want more of the same. Let me know your thoughts on BDCs if you want more BDCs reviewed, or if you prefer the traditional companies we review and the REITs. And as always, do click on that pinned comment below if you want to grab a copy of the intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your portfolio or watch list. As always, have a great day and catch you on the next episode.